going to get started since it's 5 o'clock. So good afternoon and welcome. And it's really nice to be back at this event to speak. And as I was preparing for today in my office, I have all these previous eye-opener slides. And the one on IFRS, when we first talked about this, it was the spring of 2007. So 10 years ago. And at the time, I made a joke that the standard had been so long in preparing and waiting for it that maybe I would be retired by the time it came out and became effective. I wasn't that far off. It will be released tomorrow, May 18th. That has been confirmed, and the effective date will be in 2021. So a long time. Quite a complex standard. So today, with the 45 minutes that we have, we can't really do anything really technical. It wouldn't really do it justice, but what we're going to try to do is really give you a high-level summary of what the model is, and then spend most of the time on what we think are some of the key questions that you should look to answer as you're trying to assess the impact that this new standard will have, not only on your financial reporting, but also on your business, on your products, on your systems. And then we'll talk a little bit about next steps, and we'll open it up for question at the end. So if you do have questions, we will take them. And Marco and I are going to both talk to these 10 questions. I'm going to probably focus more on the P&C side, and Marco will focus more on life issues. So that's the quick agenda, but let me jump into the timeline. And you know, 2021, it seems pretty far away. But as you recall, when we did the IFRS adoption in 2011, the full IFRS adoption, there was a requirement to have 3 balance sheets. And that's really so that all the periods are comparable and the 2 P&Ls are comparable. So you need 3 balance sheets for that. So when you factor that in, somehow that timeline already is a lot shorter. So that's probably all I wanted to draw on that. The standard, I said, is going to be issued tomorrow. A lot of our comments are based on drafts we have seen and also the decision summary of the various meetings of the ASB. We have not seen the final wording, so you know there may be some fine-tuning, but we're pretty confident that those, you know, there wouldn't be any significant changes. So 3 balance sheet bring. Oh, you know what? I did want to mention something. So recently, I did an informal poll. And that was of the top 20 P&C insurers in Canada. And it was quite a good representation. So it wasn't like statistically correct, so you know, caveat. And I asked 3 questions. What do you think the impact will be? What do you think the effort will be? And how far are you with your assessment? And 75% said it will have a big impact, medium or high. 100% said it would have big efforts, medium or high. And only less than a quarter had started a detailed assessment. A full quarter said we're waiting for the standard to come out, and the other 50% were saying, well, we're mobilizing a team, developing an action plan, but no detailed assessment. So when you put that relative to that timeline, I think things are going to start accelerating.
Yeah, and on the life side, you didn't have to do a poll. It's going to be a lot of effort. It's going to change a lot of things, like a lot of impact, right? Mm-hmm. So we'll get to that during the presentation.
So new standard, 1 model, 1 measurement model, and within that model, there's 3 approaches. So the default model, or the general approach, would be the building blocks approach, and we're going to talk about it in a minute. Then there is an optional model, and it's a simplified model, and that one is called the premium allocation approach, and that's really available for short-term contracts. And then there's a 3rd model, which we're not really going to address today, but that would be a model specific for contracts where the benefits are linked to underlying items, and there's variability, for example, in the yield, and the benefits would vary with that. So that's a specific model.
Yeah, I'll just probably, as we're going through it, I'll mention some differences or key differences with the business block approach, but similar in many other respects.
So the building blocks. So if you start with kind of the middle column there, and sometimes people put it 3 blocks, 4 blocks, but I'll go through them. So the first one is really you start with your cash flows. And what the cash flow that we're talking here are probability weighted cash flow, expected cash flow. So today we talk about best estimate cash flow. There's a little bit of a debate. Will those be the same cash flow, yes or no? That's a debate for another day. But then you want to bring those cash flow back to today's value with a discount, and that would be the second, but in my case it's in that first bucket. And the big difference there is in the past you look to the assets that were backing the liabilities. Go forward, we've cut that link and we're looking at the characteristic of the liabilities themselves. So now you have discounted cash flow, which are uncertain by nature. So we're going to add a risk adjustment, really trying to take away, or maybe better said, to reduce some of that risk that the liabilities may not be sufficient to cover future claims. And really not dissimilar to the concept today of PFAS. And then finally, the last one, that's where the big difference is the contractual service margin. You'll hear it as CSM, and we're probably going to use some jargon, and this standards is full of jargon. So the CSM, so contractual service margin, and that's basically the unamortized or unearned profit that's built into the contract, and it's going to be amortized and taken to income over the life of the contract. So those blocks, that's how you would value the liabilities for the remaining coverage, so the unexpired period. If you incur a claim or an event, then you use the same first two building blocks, but there's no CSM. And that's a big difference because there's a lot of complexity in the CSM. So that's the default model. Let me jump to...
Can we just maybe one point on the VFA? The VFA model is the same as the BBA. I mean, there's a lot of other complexities, but two key difference is that you're going to discount at a rate that's tied to the return of the assets for VFA, the variable fee approach. And then there's going to be a component of the CSM is going to be different as well, and I'll touch on that a little bit later.
So if you go to the premium allocation approach, so PAA, what you're doing, and it's a simplification that the standard allows, and it's really replacing that first column with all these building blocks and the complexity of the CSM. Forget that and replace it with something that is very close to what we would know today as UPR, except that the acquisition cost would also be netted. And so right away, you can see that it's much simpler and much closer to what we're used to today. There's no change, though, for the liability for incurred claims. We're still using the first two building blocks, so discounted cash flow and risk adjustment. But again, a lot of the complexity is within the CSM, that service margin, so that's why this model was offered as an option. So top 10 questions, I was going to say David Letterman style, but then I realized we started with number 1. We're supposed to start with number 10 and go down. But they're not in any particular order. It's more things that we should think of, and we took them kind of the flow of how you would look at your contract, but they're all important. So let me jump in the first one. And when can we adopt this simplified approach? And really the standard, it's meant for short-term contracts. So if your contract is 12 months or less, it's black and white, you're good, you can do the PAA. Now, if you have contracts that are 18 months, 24 months, or a little more, then you have to ask yourself the question, if I do this simplified method, is it a good approximation of the building block approach? And if you can conclude that it's not materially different, then you can adopt the PAA. So I've mentioned, you can, if it's not materially different, just in that, you can see there's judgment, right? There's no fast rule, so it's a gray zone, and you're going to have to go through it and discuss it probably with your auditors, and we'll see what develops. But the standard is really not meant to be, if you have a 3 or 4 year contract, I think it'd be really, really hard to get there. But anyway. Another one where it's going to be gray, it's around past events. So when you're insuring events that have happened, so if you acquire a book or if you do title insurance, retroactive reinsurance. So the event is past. What you're looking for that period, that the 12 months or not, is the coverage, the time it will take to settle those claims. So some of these claims could actually go much longer than 12 months. And again, so then where are you? It's a gray zone. Multi-year contracts, again, to be assessed, so surety, engineering, we'll see. And as we go through that exercise, you're looking at, in total, would that be materially different or not? And really the onus is on you to demonstrate that it would not, then you fall in the PAA. I want to address one of my little wheels, which are things to think about, I guess, consequences. So the first one was mutuality judgment. The other one is an option. So you don't have to go to PAA just because you meet the criteria. And the reason one may not choose to do that is if you have, I don't know, 10 or 15% of your portfolio where you cannot do this approach, so you still have to do the building blocks, then now you're dealing with two approaches. So is it easier to say, you know what, I have too many contracts that don't fall into that, so I'm going to apply BBA consistently through all my portfolios. So that would be a judgment.
On the life side, PAs generally is not going to be applied, but you will have definitely an example where that'll apply would be group insurance. It's just that in life business, typically you could have long-term contracts.
So second question is, at what level should we aggregate? And we'll talk in a minute why it's important how we aggregate, because it's going to drive some decision around the timing of how you earn your premium or your profit. So it is at the portfolio level, so you aggregate at the portfolio level. And the standard says, well, it should be determined at inception of the policy, so when the policy is issued. And when you think about today, the way contracts are grouped for purpose of measuring liabilities, it's really based on accident year. It doesn't matter when you actually wrote it, so it's a little bit of a difference at inception. Then you're looking at similar risk. So auto versus home versus liabilities, those are different risks, so those would be different portfolio. And then looking at managed together. So within auto, is auto in Ontario the same as auto in BC? Are you pricing them the same? Are you reserving them the same? Are you managing them together? So that will drive your decision around portfolio. No kind of black line, gray judgment. So again, discussions, to get everybody on the same page. Then you go a level down from the portfolio to do the grouping. And the grouping is really based on the profitability of those contracts. And the standard looks at three buckets. Those that are onerous, so loss-making, those that are very profitable, and then everything in between, which you kind of need to monitor. So the onerous contract, to give you an example, for example, auto. So if you price all your auto for all the age group at the same average profit, you probably say, well, that's one group, and that's how I manage it. But sometimes you may say, well, actually, I'm going to lose some money on some of the extremities, the very young driver or the older driver, and those would be loss-making. So are you managing them as one or not? Are they one group or not? So it is an important decision, because with onerous contract, you have to recognize the day one loss right away. And so the way you group them is going to drive the results of the timing of your loss compared to today.
Yeah, so I'll just expand a little bit on that. That's really the important point is, why are we doing all of that grouping? It's all about the contractual service margin, which I'm going to address in the next slide, I think. And the CSM prevents the front-ending of profits, right? So if I don't have those profits at inception, that means I can offset those losses from onerous contracts. So that's a big difference from what we have today, because we front-end everything profit or losses, so they offset each other. So everything else being equal, on a net basis, you'd expect to have more earnings strain from IFRS 17 that you have today. Another question is why do we have to worry about this other group where you're separating them from the very profitable and the very onerous? Well, that's because that group, you're going to have potentially some onerous contract in there that will now offset within the group with the profitable contracts. And so if I bring even more profits into this, then that means I may be hiding contract with losses, and ISB doesn't like that. So they say, well, let's make that other group, and going to remove a lot of the profitable. And if you truly have onerous contracts, hopefully we'll be able to see that. And the thing is with that group, although it's profitable at issue, it can become onerous over time as well. So it's very important that that separation. Huge gains there, because I can tell you at the beginning when we were discussing that with the ISB, it was there was a contract level. There was no grouping. So every losses would have gone through the P&L.
So before I move on to the next topic, I want to talk about the system a little bit. So you can see now that you have to, gather information at the portfolio level, which is different than what we do today. Gather information at the group level. Then you have these contracts that are kind of in between, where you may not have to reverse later day one profit. It's a lot of data points and new data points, and so your system will need to be able to gather that and track that. So that's why when we say the impact will not just be on financial reporting, it will be on the underlying system that gathers the information. So CSM, I'm going to hand it off.
The famous contractual service margin. This is really where all the complexity is. So I'll talk about that in terms of more mechanically how that works. So don't take any notes. Not expecting you to catch that, but I think it's the message that we're trying to get through here. So at inception, if we look at a contract level, so not the group level, at inception, the CSM is actually a very simple calculation. We have all the information to do that today. Essentially, we look at the present value of your fulfillment cash flow. So this is the best, your expected cash flows, present value. Then there's the second block is your risk adjustment. So you add that up, and if you've got profitable products, your premium is more than sufficient then to cover the benefits and some margins to it. So those two amounts together would be negative. So all you do is you take the CSM is the amount to offset that, so you don't have a negative reserve, you have a reserve of 0, so nothing goes to the P&L. So that's pretty simple. That's a contract level. So on the other hand, we're talking now about groups of contracts. So how does the CSM work? So on a subsequent basis, after, let's say you start Jan 1st, 21, you're going to have your first quarter, then you get to the next quarter. One of the things about CSM is you can actually accumulate contracts over a period of time of a maximum of 12 months. So how does that work? So the CSM at the end of the period will be equal to your opening balance. Then you're going to be adding the CSM from new contracts in the period. You will also putting the change in future cash flow of your liability to the CSM. And then you're going to have interest accretion at a locked-in interest rate based on the date of the inception of the group of contracts. And then, so when you have that big amount, this is where you're going to do an amortization of that amount over the coverage period of the group based on the coverage units. So coverage units, this is where we're saying this is typically, we're referring to it as a level amortization over time. So as Alodie was mentioning, you're seeing there's a lot of data points that we don't capture today that you'll have to capture. You can have locked-in discount rates and several curves of those historically that you'll have to capture. You're going to have information on your profitability, so you can do the grouping. You're going to actually accumulate a lot of those groups over time in cohorts because they're going to be there for years. So try to do that on an Excel worksheet. And then another complexity is that the IFRS allows favorable change in future cash flows to go to the P&L instead of the CSM, only to the extent that it's reversing prior losses that you put to your P&L. So now you're going to have to track those losses by cohort, by groups, forever until those groups go away.
And now you all understand why we're all trying to go into the PA model.
That's right.
Because you have no CSM.
And this is only some of the complications. I could be here for a few more minutes talking about it. But that's that's the BBA. Just a little note on the VFA. So the VFA now is that, again, very similar principles and all of this, but you don't have the interest accretion anymore. You're replacing that with the change in the variable fee that the company is getting from the contracts. That's not really very intuitive. If you want to talk about this later after the session, we can do that. But that together with the fact that you're discounting the rate earned on the assets, supporting it, makes it so that in the end you're not going to have an interest rate gain for your portfolio. So you're going to have no volatility from interest rate as a result of that. So I'll touch on that a little bit more later.
I'm going to keep moving, otherwise we're not going to get through our top 10, are we? Discount rate.
Yeah, that's mine. That's life insurance. That's been a huge issue. Everyone knows about that. I mean, for life insurance, you're talking about 20, 30, 40-year cash flow. So it's becoming, you have a liability that's extremely sensitive to changes in discount rates. So now, as we said, you're not linked to interest rates anymore. We're talking about the BBA. And so the interest rate or discount rate is based on the characteristics of the liability cash flows. And effectively, what that means is you're going to have a discount rate equal to a risk-free rate plus a premium for illiquidity. Again, premium for illiquidity, how you're going to calculate that, that's a separate discussion, quite complex, but that's totally untied now to the assets. So is your discount rate going to change? You definitely will. The extent of it will depend on a number of things. Your IFRS 9 classification of the assets. Actually, the interest rate is not going to impact that. That's not going to be the interest rate, but the volatility will be impacted by the classification of your IFRS 9 assets. You're also going to have to look at the term of your liability. You are going to look at the type of risk that you have, and certainly also the cash flow match that you have. If you've got the better your cash flow match, the less the impact would be relative to if you're using a fair value, fixed, non-fixed income asset. So there's a lot of things that you'll have to look and assess to really understand the impact from a volatility perspective. And to help you with that volatility, the IFRS is giving an option to use an OCI as far as interest rate movements are concerned for the calculation of the liability. So the way that works is that the interest expense on the liability calculated at a locked-in discount rate at the inception of the group of contract, that's what would go to the P&L. The difference of that liability or the interest related to that with the liability calculated at current interest rates, that would go to the OCI. So that OCI clearly will recycle itself automatically because you get two reserves going down to zero over time.
Just a note on the IFRS 9, that is why, because there's so much correlation, that for insurers, you're allowed to defer until you adopt IFRS 17 into 2021. And actually, it's mandatory per OSFI for the life goes. It's an option for the P&C, but I haven't heard anybody who doesn't want to defer yet. I think this is yours too.
The risk adjustment.
But keep us on track.
Okay. So risk adjustment, similar to PFADs, it's different concepts, but similar. This is an area of the IFRS where actually there's very little guidance. It's actually very not prescriptive relative to anywhere in the standard. So the entity can choose its method to calculate that and level of aggregation for diversification credit. And three methods have been discussed, as you see there with the ISB, but you can choose anything else. Actually, there's a view that the current PFAD approach we're using could fit that. The catch here is that because this is wide open, you can do whatever you want. You have to disclose in your notes the level of confidence of your risk adjustment. So this is one of the methods. So that's gonna allow comparability between companies. So if you end up choosing another method for your financial statement, you'll be stuck doing two calculations for your risk adjustment.
Just a quick comment. You mentioned the PFADs, pretty similar. Today, the PFADs, there would be three type of PFADs, yep, including one for interest rate risk. That one is gone.
Right.
So it's similar to the other PFADs. So acquisition costs. Today, there's a mix of what is deferred, what is not deferred, and this is more of a P&C, I guess, terminology, but some people just defer their premium tax and commission, and some do defer some direct attributable cost or directly linked to to writing the products. Go forward, you have it will change for everybody because either you take the exemption to defer anything, and that's for contracts of 1 year or less, so you don't defer anything. Or if you decide to defer something, then you cannot just defer commission and premium tax. You also have to defer directly attributable cost. So there will be a change there. And the only little change as well is that you could even start recognizing some of these costs before you start, the coverage of your insurance policy if those costs are incurred. And
an important point to make, I think, is the level of acquisition expenses that will be in your fulfillment cash flows are going to be a little bit lower, because we're talking about those are directly attributable to the portfolio. So the number of overhead they're not going to be there anymore.
So reinsurance, so the model is actually the same for insurance, reinsurance is the same model, but you could have a mismatch for a number of reasons. First, you could have your direct insurance fit into, for example, the PAA approach, but the reinsurance that offsets, or the matching, the mirror, falls into a different model. It becomes the building blocks approach. And that could be the case, for example, when you have a simple quota share where really the insurance is risk attaching to all the policies issued into 1 year. So you issue policies from January to December. December, that policy goes for 12 months. So you can see that the reinsurance contracts are actually longer than 12 months. So that could be one thing. The other one is this, day one loss. You cannot recognize the profit on day one, but you have to recognize the loss. So if you're loss making and a reinsurance that would normally kind of offset, you're not now booking them at the same time. So you have another mismatch. And the third one could come from the fact that in the cash flow, you now have to build allowance for default of reinsurance. So those cash flows, again, are not quite matched again.
Another point that we've added there is something that some of you may not be aware of, because that's not discussed very often, is that the reinsurance contracts will be recognized in your statements differently, whether they provide aggregate coverage or individual coverage. So individual coverage here, we're talking about a reinsurance contract that compensate the direct writer for losses on each individual policies one by one. So for those contracts, the recognition of the reinsurance asset will be at the same time as you're recognizing the liability under your direct underlying contracts. For reinsurance contracts that are providing aggregate coverage, so those are where the losses and claims need to be accumulated over a number of individual contracts over time before the reinsurance actually pays out. For those contracts, they would be recognized, the asset would be recognized at the inception of the contract. So technically that means, because we're talking about probability weighted cash flow, you may have to project new business. That's a little controversial, but there's debates around that, so hopefully tomorrow we'll have the answer to this, but that's a complication as well. Transition. That's another hour. So all we're going to limit ourselves today is the approach that you can use in measuring your liability for your whole in-force block of business on transition. So the default approach is the retrospective approach, and that one is simply explained is you have to apply your IFRS 17 literally going back to 20, 30, 40 years down. So that means you have to recreate history, you have to know your acquisition expenses, you have to know the assumptions we're using. No one's going to do that, right? It's impossible. So the IFRS is saying, well, if that's impractical, surprise, you have two options. You can do a modified retrospective, or you can do fair value. So the modified retrospective in mechanics is very similar. It's the same as the full retrospective, but it allows for a number of approximations around how you determine your interest rates, at what period of time you can determine which contracts go, or which groups are onerous or profitable, cash flow adjustments, a number of things. But in the end, it's still relatively quite complex to do. And so what we're expecting is that most companies will fall under the fair value approach. And the beauty of that approach, again, mechanically, is that you don't need to look at your historical information at all. It's all prospective. So you look at your future cash flow, and then you take the fair value of that, and the difference between that and the fulfillment cash flow on an IFRS 17 basis. That's the first two blocks, the probability weighted cash flow and the risk adjustment. That difference is your CSM. Now, importantly, that CSM will clearly be different if you use the modified approach. So the question there is you're going to have to do some analysis because you may have a position on CSM for your in-force block. Do I want to have a high CSM, a low CSM? You know, there's considerations to be done. So although the fair value is simpler, maybe you're going to get a better answer with the modified retrospective. So a lot of analysis there, and you may end up actually, those are decisions made at the portfolio level. So you may end up being in a situation where it's like, I do have the data from the last maybe 3-5 years, so I'll have to do the full retrospective, and I have no choice. And for that, maybe I'll be like full fair value for everything. And under fair value, one more point is that you don't have groupings at that point. For that portfolio, it's one cohort.
Did I say we're not going to be technical? I'm not sure you got the memo.
I'm an actuary.
Okay,
what do you want?
I need to keep moving, Marco. Okay. Do I need to expand my disclosure? Yes. And you know, tongue-in-cheek, I said, where did my premiums go? So everybody was talking about the fact, oh, there's no more written premium, which really gives you a sense of volume. And many company, that's a key KPI. So there's still something similar. So on the P&C side, there would be a concept of earned premium if you were in that PAA approach. And you know, I'm sure that the written premium will make their way to disclosures. Expanded disclosures, the building blocks, there is a requirement to reconcile opening to closing balance for every single block with the different elements. So think about all that nice tracking of information and a lot more information coming from the actual department versus the finance department, right? So today, I mean, we do have development tables and things like that, but it will be more. And then just to, again, mention that confidence level, which is kind of a new disclosure, because you're kind of sharing a little bit the conservatism that you've built or not in those reserves. He's afraid now to say anything.
Oh, do you want me to add anything to this?
No,
we're good. We're good. We have to move,
this
right?
This is yours.
Okay. So this is actually my favorite subject, and this is totally not technical. This is, for me, personally, seeing the forest behind the trees. We spend a lot of time talking about the complexity of the mechanics of IFRS 17, but the bottom line is really this. From an operational perspective, again, remember now you're going to have, as Alodie was saying, you're going to have the actuarial area driving most of your components of the P&L now. That means changes in process and system. Actuarial will have to have different controls, different materiality limits they'll have to live with. Your ledger is going to change. I mean, you're opening up so many things as a result of that. Then from a business perspective, look, we're changing, the IFRS 17 is changing the profit emergence of your business. Tell me one area that's not going to be impacted by that, right? Everything's going to be impacted. And so you really have to be able to step back and say, okay, what's the real business implications of this? I'm going to have to do some repricing on some products. My KPIs are going to change. Premiums are not on the P&L anymore. You can still use it in your disclosure note, but it's not in financial statements. Your business plan, you'll have to do a 5-year business plan before you're ready to implement IFRS 17, pull the trigger on January 1st. How are you going to do that? So there's a lot, and education. I mean, you have to educate internally. People have to relearn their business. You have to do that education externally, investors, analysts. I mean, it goes on and on. So really important as you're doing your planning to understand the pervasiveness, at least for life insurance, on the impact of IFRS 17.
And I think maybe the default has been saying, oh, it's a life issue, it's a life issue. Yeah. I hope that after today and some of these questions that we've gone through, that the P&C insurers in the room are thinking, well, maybe, you know what, it is going to be a change for us as well that will impact our system, our business, different KPIs. So we want to spend the next few minutes on next steps. Yeah. And I think looking at it as, well, we have to do it, but maybe should we do more with it, right?
That's right. So, let's work backward. So we've got January 1st, 2021 is the effective date. Pretty sure that's what we're going to see tomorrow. And so then you have 2020 where you have to do your comparative. So as we were saying, you need three years of balance sheet to do that. So that's something certainly that you want to be ready for in 2020. But really, I think from my view is that with 2020, the real issue is that you want to be testing your IFRS 17 at that point. Like, you're done with major implementations. You have to be just doing some refining, because this is your chance to really understand your business live and be ready when you go to market in 2021. So what that leaves you, if you haven't, if you haven't started yet, you've got 2.5 years to do all of this. So by default, I think what we're saying is that probably, you have now the next 6 months. So this year, you want to make sure that your planning is done, your impact assessment is done, and you want to have your teeth synced into your policy accounting decisions, because there's a number of places that's going to be interpretation or decisions need to be made. If that's not done or close to be done, at least on the major ones by the end of this year, it's going to have a waterfall effect on the rest of the 2 years that you have to implement everything. But with change comes opportunity. And so I won't spend too much time here, but the opportunity that comes with IFRS 17 is that you're really opening up. You saw how pervasive it is. So you're opening up so many systems and processes, and that's the chance to look at this much more holistically than trying to do some either patchwork or tactical changes or enhancement to what's already existing, so that in the end may be not quite efficient. And so when companies are looking at this and want to look at, I think, more holistic, their question is, what am I expecting from my financial and actuarial reporting area? And invariably, the answer is, well, I want to have a proactive reporting. I want information that's value add. I want smart analytics, and I want it in real time. I don't want to have a reactive financial reporting. So in that context, this is where then at that point you look at it in IFRS 17 and you're saying, what I'm going to do is have an architecture that will give me the flexibility to modernize in the future without really impacting or jeopardizing my ability to meet January 1st, 2021. And one central and cornerstone implication around this architecture is that you would want to centralize a lot of your data warehousing and grouping and aggregation, probably even potentially where the CSM could be done. And that's really key, because it's all about data. If you want to have efficient reporting, you need to have the right data, you need to be able to mine it, you need to be able to assess it in relatively real time. And so when you've got that, then what you can easily do later is add data, make changes to systems that are not putting you in a position that you're undoing and redoing, and then really get into that proactive reporting using very smart analytics and visualization of your reporting where you want to go.
So lots to do. So we've developed some tools to assist with that assessment, and there's a group of them there, and I'm not going to talk about everything, but you can see from the size of the project, for example, that having good project management tools or resource will be important. Education of people within the finance, of your board of directors, of the people who are going to use your financials, or the different stakeholders. That's going to be another one. I'm going to talk about three. The gap accelerator at the top. So what that is the standard is long standard, it's a complex standard, and there's a lot of cross-reference within the standards. So to know how to treat, for example, I'll take acquisition costs, there'll be mention of that throughout the standard. And what we've done is kind of summarized by financial statement line item, what are all the new requirements, what is it today, and what are the differences. So there's a quick assessment of the key gaps or key difference. The other one is profit signatures. So we mentioned a number of times that the timing of when profit will be realized is going to shift quite a bit. And so I think what's important is to understand what that means concretely for your products, your portfolio. So the profit signature is a way for modeling your portfolios and understanding how that profit is going to change from today. And then the final one I'm going to mention is the model options. So there's a number of choices within the standard. And again, we've kind of built models so that you can have a quick assessment of what the impact would be on some of the key KPIs, ROE, others. And so that will enable you to choose from different options and understand the impact quicker, I guess. And those are just a few, and you know, we can certainly spend more time if you have any other questions. And with that, I think I'm going to open it up so that we make sure we address what's important to you.